What if the interest rate on your savings account wasn't decided by a policy meeting, but by an algorithm analyzing your behavior? Not where you bank, not how loyal you are, but how likely you are to stay or leave. In this video, we're exploring the uncomfortable question banks are starting to face as AI enters deposit pricing. Should finance prioritize efficiency or fairness? Because once AI starts optimizing money, the rules feel less neutral, and understanding those rules might matter more than you think. The question, nitrogen monoxide, bank wants to answer. What if the interest rate on your savings account wasn't fixed but calculated specifically for you, not based on a national rate, not based on a promotion, but on your behavior, your balance, your loyalty, and how likely you are to leave? Banks already have the data. AI already has the capability. So why aren't banks fully using AI-driven deposit dynamically? In this video, we'll explore why banks are experimenting with AI-driven deposit pricing, why many of them are afraid to go too far, and how this quiet tension could reshape the future of banking without most customers ever realizing it. Why deposits suddenly matter again? For decades, deposits were boring. Banks focused on lending, investments, and fees. Deposits were simply the raw material, cheap, stable funding that quietly sat on balance sheets. That changed. Rising interest rates, fintech competition, and digital banks offering aggressive yields have turned deposits into a battlefield. Customers can now move money in seconds. Loyalty is thinner. Switching costs are almost zero. For banks, deposits are no longer passive. They're strategic assets, and strategy demands optimization. That's where AI Satu enters the conversation. What AI-powered deposits actually mean? When banks talk about AI Satu in deposits, they're not talking about robots setting interest rates randomly. They're talking about machine learning models that analyze customer behavior over time, sensitivity to interest rate changes, likelihood of churn, product usage across checking, savings, credit, and investments, how customers respond to past rate changes or promotions. In theory, AI Satu could recommend who needs a higher rate to stay, who would stay even with a lower rate, when to offer incentives, how to retain balances without overpaying. From a business perspective, this is logical. From a technology perspective, it's already possible. So why the hesitation? The dynamic pricing problem. Dynamic pricing works everywhere else. Airlines change prices by the minute. Ride-hailing apps surge prices automatically. E-commerce platforms personalize discounts invisibly. But banking is different. Interest rates aren't just prices, they're trust signals. If customers discover that two people receive different rates for the same product, rates change based on behavior they don't understand, loyalty doesn't guarantee fairness. The backlash could be severe. Banks fear headlines that say, "Your bank thinks you're worth less," or "AI Satu decides how much interest you deserve." This isn't just a PR issue, it's an existential one. The transparency dilemma. AI Satu models are powerful but opaque. Even bank executives may not fully understand why a model recommends a certain rate for a certain customer. That creates three major risks. 1. Customer trust. If pricing can't be explained, it can't be defended. 2. Regulatory scrutiny. Regulators demand fairness, consistency, and explainability, especially in financial products. 3. Ethical boundaries. Should customers who are less financially literate receive worse rates? Should loyalty be penalized because it signals inertia? AI Satu can optimize outcomes, but optimization without values is dangerous. Why banks are flirting, not committing. Most banks today are experimenting quietly. They use AI to simulate deposit pricing scenarios, segment customers internally, predict churn risk, test personalized offers in limited pilots. But they stop short of full dynamic pricing. This creates a middle ground. AI Satu informs humans but doesn't replace them, for now. What fintechs are willing to do that banks aren't? Fintechs don't carry the same legacy expectations. They can experiment faster, adjust pricing more aggressively, communicate changes as features, target niche audiences without universal backlash. This puts pressure on traditional banks. If fintechs normalize personalized pricing, banks may be forced to follow whether they're comfortable or not. The real question, fairness or efficiency? At its core, this debate isn't really about artificial intelligence, it's about values. For decades, banking has operated under an unspoken assumption that customers are treated equally. Same products, same interest rates, same terms. That perception of fairness has been central to trust in financial institutions, even if the reality was always more complicated. Because behind the scenes, banks have always segmented customers. They've grouped people by income, by balance size, by risk profile, by relationship depth, and by profitability. Preferred customers receive better service, better offers, and faster approvals, just not always in ways that were obvious or measurable in real time. A.K. Satu doesn't introduce inequality into banking, it makes it visible, and visibility changes everything. When AI enters deposit pricing and financial decision-making, it forces banks to confront a difficult question. Should the system optimize for maximum efficiency or for perceived fairness? From an efficiency standpoint, the answer seems obvious. If AI can identify which customers are likely to leave without better rates, banks can retain deposits more cheaply. If the system knows which customers will stay regardless, it avoids overpaying. Capital allocation becomes smarter, margins improve, risk decreases. But fairness doesn't operate on spreadsheets. Fairness operates on perception, emotion, and trust. Customers don't compare themselves to algorithms. They compare themselves to other people. The moment two customers discover they are being offered different outcomes for the same product, the system feels unjust, even if the logic behind it is economically sound. This is where A.E. Satu becomes uncomfortable. Because AI exposes the truth, banking has long tried to soften. Equality of treatment has never been absolute. It has been managed, averaged, and abstracted. The difference now is scale and speed. A.E. Satu can personalize decisions instantly, continuously, and invisibly. What once required manual review and human discretion can now happen millions of times a day without friction. That power forces institutions to define boundaries they never had to articulate before. Is it fair to reward loyalty if it comes from inertia rather than engagement? Is it fair to penalize customers who don't actively shop for better rates? Is it fair to optimize pricing based on predicted behavior rather than explicit choice? These aren't technical questions, they're ethical ones, and no model, no matter how advanced, can answer them alone. Ultimately, the future of AI in banking will depend not on how accurate the algorithms are, but on how clearly institutions decide what fairness actually means in a world optimized by machines. Because efficiency can be calculated, fairness must be defined. And in the age of A.A. Satu, defining it may be the hardest decision banks will ever make. A.A. Satu doesn't create inequality, it reveals it. And revelation is uncomfortable. The future, quiet adoption, not radical change. The most likely future isn't dramatic. Banks won't suddenly announce, AI now sets your interest rate. Instead, A.A. Satu will gradually shape offers, influence retention strategies, adjust incentives invisibly, operate behind human decision layers. Customers may never know exactly when AI intervened, and that may be intentional. When pricing becomes perception, AI-powered deposits represent one of the most sensitive frontiers in modern banking. Not because the technology isn't ready, but because society isn't. As banks balance innovation with trust, one thing is clear. The future of finance won't be decided by algorithms alone. It will be decided by how comfortable we are letting machines influence something as personal as the value of our money, and whether we're ready to ask not just what AI can optimize, but what it should never touch.